Welcome everyone. Before we start, can you all put your hands up if you can hear me, please? Excellent, thank you very much. Okay, and to put your hands down a second, and can you put your hands up again if you can see my slides? Great, thank you very much. Well, I'm Simon Marshall, and I'm a senior partner at Action Coach Business Coaching. So today I'm going to share with you financial management tips every business owner should know. As I've got a lot of people, I've got a lot to get through today, I'm going to answer questions at the end, but feel free to type them in the question box as we go along. Okay, great. So let's move into things. What I wanted to share with you first was, sorry, just checking my screen here. Okay, all should be okay. Great, okay. So look, what I wanted to talk to you about first is that it takes about 8 minutes to become a business owner. Okay, so you have to learn very quickly. You have to learn about sales and marketing and financials and human resources. Okay, so these workshops that I'm doing will build your knowledge, and it's set across all areas of the business, enabling you to make smart business decisions to grow your company. Okay. Now look, it's rare for a business owner to train themselves. So you're in the top 5%. Now look, I've got 2 words on the screen here. Why are these 2 words the most expensive or the most costly in the world? Let me explain. Let me give you an example. Okay. Now, if anybody on the call's got teenage children, they've probably heard them saying this before. You know, if you're speaking to teenage children and they cross their arms and they say, yeah, I know. Okay. Now, when we get older, we do this, but a little more politely. Okay. And we might say it to ourselves in our head. But what this does is this approach kills the possibility that maybe you can learn something from this conversation. Okay? Now, instead of saying, I know, what I say to people is think of these words instead. Isn't that interesting? Ask yourself, isn't that interesting? If you already know it, ask yourself, well, why aren't I doing it? Or ask yourself, how can I do that differently? Or can I do it better? Don't just think to yourself, I know. Okay? So let's try and do that through this webinar today. If there's anything that you already know, just ask yourself that question. Isn't that interesting? Okay, so look, I've seen this many times before. Business owners think they have a healthy business because they are busy. Okay? However, the health of a business is much more complicated than just being busy. In order to evaluate the health of your business, you need to know what numbers are important. Healthy businesses have reports and dashboards that are utilised regularly, assessing different aspects of the business. Okay? They are basic numbers that should be looked at monthly, like total revenue, total expenses, overhead percentage, and profitability. There are many other nuanced numbers that help you understand your specific business, okay, like client acquisition, lifetime value, repeat business, cost of goods, and many more, okay? So these higher level numbers provide more in-depth analysis on how to drive profitability and ultimately the financial success of the business. So today, we're going to dive into which numbers are important, how to calculate them, and how to utilize those numbers to drive your business success. Right. This is something I come across more and more with business owners. Most business owners I've met learn to discount before they learn to count. So let me just explain that in a bit more detail. Now, I like to use this as an example. So let's just talk this through. If, for example, your gross profit is 40%, okay? And if you reduce your prices by 10%. Okay? You would need your sales volume to increase by 33% to maintain your gross profit, your pound gross profit. So you'd need to do 33% more business to actually get the same amount of business. So let's put that into another example. Okay, so in column 1 below, a company sells 100 units at £2 each. Okay, so their net sales are £200. Each product costs £1.20 to produce. So they make 80p profit on each product. So that's a 40% gross profit. Okay, on 100 units, they would make a gross profit of £80, as you can see from this chart here. So in column 2, if they discount their prices by 10% to £1.80 and sell the same volume, they would have net sales of £90. Okay, of 100 units. So £90, 100 units at £1.80 equals £180. The product cost of 100 units remains at £120. So they make a profit of £60. Okay, as you can see, the grey bit here. Their gross profit margin has now decreased to 33.33%. Okay, and then if we move on to column 3 with this lower gross profit of 33.33%, for the company to generate their original profit of £80, they would need to sell £240 in sales at £1.80. So that's 133 units, so 33% more units. Okay, an increase from 100 units to 133 units, increase of 33% in turnover. Okay, so this is the impact of discounting. So what I'm going to show you today is the other things that you can do besides discounting. What are the things that you can do besides discounting? Okay, look, if anybody's got any ideas, just type them into the chat box. Okay, what can you do other than discounting? Okay, I'll just give you a couple of minutes to a couple of seconds to type some things in there. Have a think about what you can do. Okay, well, let me share some things with you. Okay, let's get those creative juices going. You can give away perceived value, things that don't cost you much, but for the customer, they really value them. Okay, and it could be simple things. It could be like free tea and coffee. It could be a guaranteed appointment time. Okay, it could be items you want to get rid of, low-cost items, free gift wrapping, free electrical safety check. Okay, these are things that you can give away to create value so that you don't have to discount. Okay, so now what we're going to look at is some beliefs about money. So again, look, if anybody's got any on this call, anybody's got some beliefs about money, let's type them into the chat box. Any belief that you've got about money. Okay, I'm going to share with you in a second some beliefs that I come across with speaking to business owners about money. Okay, now let me call them up on the screen now. Okay, so how many of you came up with these things? It takes money to make money. The rich get richer, the poor get poorer. I can't live a balanced life if I want to make a lot of money. To make more money, you must take big risks. Life is hard. Most wealthy people are like Ebenezer Scrooge. Okay? Look, these are all negative beliefs about money. Yeah? Money is as basic to our well-being as health or relationships. Okay. As Zig Ziglar, an American author, salesman, and motivational speaker says, money isn't the most important thing in life, but it's reasonably close to oxygen on the gotta have it scale. Yet our culture has a real love-hate relationship when it comes to money. Think about health. Okay, so if I was to walk into a training room, a football dressing room or something, and there were strangers in there, and I announce I'm dedicated to having as much health as possible, I'm guessing that I'd probably get an instant respect and maybe even a standing ovation. But if I walked in to that same room and announced, I'm dedicated to having as much money as possible, what kind of judgments do you think people would make? They'd probably think, wow, that guy's really greedy. So just like we have unconsciously brought into our culture ideas about beauty and fairness and success, and many of us have brought into the cultural myths and archetypes around money. So these are some of the positive beliefs that people have around money, okay? And this was from a research of prosperous people. Not all of the people interviewed were uber wealthy, but they all had what they wanted in terms of money and the ability to create more whenever they desire. Okay? Which of these 8 beliefs of prosperous people ring true with you? I don't just mean intellectually. How many of those beliefs are wired into your system as absolutely, positively, no doubt about it, true? Okay? Unfortunately, we can't just memorize the list above, okay, to shift our beliefs. And therefore, our actions, habits, and perceptions around money, okay, we've got to change the underlying limiting beliefs. Okay, and that takes some work and some focus to do. But it can be done. So look, let's move on to some more things around sort of financial mastery. There are the key areas of financial mastery, okay? So initially, we're going to focus on the top 3 of these. Okay, so we're going to focus on profit and loss, balance sheet, break even. And what I'm going to do is in another webinar, I'm going to focus on cash flow and investments, okay? So look out for that webinar when I advertise that. But we're going to focus on the top 3 today: profit and loss, break even, and balance sheet. Now, let me just explain in brief what these are. So the profit and loss shows the company's revenues and expenses during a particular period of time. It indicates how the revenues are transformed into the net income or net profit. Okay. Then you've got your balance sheet. Your balance sheet is a snapshot of the company's financial condition. And finally, your break even, the point at which total cost and total revenue are equal. Okay, i.e. they're even. There's no net loss and there's no net gain. Okay, so we're going to delve down into these in a bit more detail. But first of all, I just want to touch on some key performance indicators. Okay, so look, put your hands up on the call if any of you have got key performance indicators in your business. Okay, just put your hands up. Okay, so we've got a couple of people that have put their hands up there. Not everybody. Okay, I'd probably say there's about sort of 20% of people have put their hands up, maybe 25. Okay, so KPIs evaluate the success of an organization or of a particular activity in which it engages. Okay, it's about understanding your numbers, historical and future numbers. Okay, so have a think. Do you have key performance indicators? Okay, for you, for your employees, for each department? Do you have a dashboard with all of your KPIs? Okay, this is the one thing we do with our clients. Okay, with all of our clients. Okay, cash flow position, leads, conversion rate. Okay, stocks, debtors, creditors, sales profit by product line and customers. These are all things that you can actually focus on and have key performance indicators about to measure how well your business is performing. Okay, so these are some examples of some other key performance indicators. I'm not going to go through the list there, but hopefully that gives you an idea of some other key performance indicators that you could have in your business, such as monthly profit or number of new customers, client retention numbers, number of sales meetings, customer acquisition cost. All things that you should be measuring. A good KPI should act as a compass, helping you and your team understand whether you're taking the right path towards your strategic goals. To be effective, a KPI It must be well defined and quantifiable. Okay, and it's got to be communicated throughout your organisation and your department. Right, so let's have a look at the first of those three things that I said I was going to delve into in a bit more detail. Okay, so what does a profit and loss make up? Look, it's actually pretty straightforward. So we've got sales. This is the revenue that you collect from selling things. Okay, and we take off that the cost of sale. Okay, the variable costs in the business, and that gives you your gross profit. Okay, then we take away from that your fixed costs or your overheads, and that gives you your net profit or your net loss. Hopefully, a net profit. Okay, so let me give you some examples here of things that would be fixed costs or overheads. Okay, so they're the expenses that you pay, whether or not you have sales. Okay, so these could be things like rent and office and marketing expenses, etc. Okay, the things that you're spending, whether you have sales or not. Okay, and then you've got your variable costs. Okay, which is materials and deliveries. Okay. Now look, both of these vary depending on the industry that you're in. So it's what's worthwhile is actually understanding and looking at the benchmarks within your industry. How are other people performing? What sort of percentage costs have they got in their business? Are you achieving better than them or worse than them? You can benchmark it. So what I'd like to share with you is an example of how this works in practice. Okay, so let's run through an example business. And this business sells widgets, whatever widgets are. Okay, and they sell red, blue, green, and yellow widgets. Yep. Now they make total sales of £122,000 through selling widgets, and the cost of sales are different for each widget, and they make a gross profit of £59,000. Then they've got a whole series of fixed expenses: bookkeeping, interest, depreciation, rent, sales and marketing, etc. So their total fixed costs are £42,000. Yep. And then that gives them a net profit of £17,000. And then they take off the tax and the dividend. Now look, dividend can only be taken if the business shows a profit after tax. When people talk about bottom line profit, that usually means profit before tax. So in this instance, £17,000. Okay, and then you've got tax charge of whatever the current rate of corporation tax is to get to what your retained profit is in the business. Okay, a business can claim lots of different expenses to reduce taxable net profit. Okay, and a good accountant will help and advise you on that. And if you want any recommendations of a good accountant, then please let me know. And also a great bookkeeper. Yeah. So I'm more than happy to facilitate introductions on that. Okay. So then looking at that business had sales of £122,000. Cost of sales was a total of £63,000. That meant they had a gross profit of £59,000. And their total sales, £122,000. Sorry, dividing the gross profit by £122,000, their actual total sales, we can work out what the gross profit margin is: 48.3%. Okay, so you're dividing the gross profit by the total sales to give you a gross profit margin. But is that enough? Does that tell us enough information? Okay, in my view, it doesn't. We need to delve down deeper into that. And in this example, what we do is we have a look at the gross profit for each of the individual coloured widgets. And we look to see, well, which one has got the highest gross profit margin. Okay? So look, just type in the chat box, anyone, which one of these, and the answer's on the screen there, which one of these has the highest gross profit margin? Okay? Come on, somebody must know the answer. It's up there on the screen. Okay, well, look, you've all come to exactly the right place because this is where you can learn this. Excellent. Look, a couple of things on now. Yeah, 2 people said blue. Thanks, Ian. Thanks, Chris. Great. Okay, so the blue widgets have got a gross profit margin of 65.91%. Now, we look at the yellow widgets, okay, over here, and their gross profit margin is only 14.29%. So, how can we use this information to increase the net profit of this business? Okay, how much extra profit would this business make if they'd sold the total sales but only sold blue widgets? So let's have a look at that as an example. Total sales 122,000 multiplied by blue widget margin of 65.9%. So the gross profit margin is actually 80,398. Less the fixed expenses of £42,000. So the net profit margin is 38,398 versus 17,000 through selling all colours. Okay, interesting, isn't it? So look, there may be a reason that this business sells all different colours. Okay, so we're looking at this at headline level, but what this tells us is let's investigate it further. Let's view it and see what we can do. Let's do the analysis. What happens if we only sell blue widgets? What happens if we stop selling yellow widgets because they've got the lowest gross profit margin? We can then start to ask ourselves those questions. Now, look, what I wanted to do was also cover with you something that Action Coach focuses on in terms of our financial numbers. And this is very straightforward. We call it the 5 ways. Okay? Now, the way we look at this is we focus on the areas in red. The areas in blue adjust the results. Okay? So most businesses focus on the number of customers that they have, what their revenues are, and what their profits are. Okay? Now, with my clients, what I focus on is the red areas. We focus on the number of leads that they're getting into their business. Okay, so I've got an example business here to show you. So let's say this example business is generating 4,000 leads. And their conversion rate, so that's the conversion rate is how many people buy from them. So they get 4,000 leads, 25% of those people buy from them. Okay, so that gives the number of customers, gives 1,000 customers. Then what we look at is how many times those customers come back and buy. And I've got strategies that we can implement for all of these red areas. We've got over 360 different strategies to incrementally increase each one of these areas. Okay, so we can get people coming back and buying more often. But in this business, they're currently coming back twice. And they're spending £100 each time they come back. So the revenues of this business are £200,000. Okay? Fairly straightforward. And then you multiply that by the gross profit margin of 25%, gives £50,000 gross profit. Okay, now what I wanted to show you is the impact of incremental gains into each one of these areas. Okay, so what we look at, as I said before, is we focus on the strategies that we can put in place to increase the number of leads for your business. So if we can increase that by 10%, and we can increase it by 10%, we've done it time and time again. We're increasing the number of leads from 4,000 to 4,400. Increasing the conversion rate from 25% to 27.5%. So by 10%, not 10 percentage points. Okay, we're increasing that. So not significantly, but we're just getting more people to buy. Again, we're putting strategies in place to do that. That means the number of customers increases from 1,000 to 1,210. Then we get those customers coming back, buying more. Okay, they're coming back 10% more often, so 2.2 times. And every time they come back, they're spending 10% more, £110. Okay, we're implementing strategies to get them to spend more. Now look at this, look at the impact of that. Revenues have gone up from 200,000 to 292,820, just by incremental gains in each one of those areas. And then with margin, now look, I generally find But by doing all the other things, the gross profit margin naturally increases anyway, but I've got strategies to increase that. So that increases by 10% as well to 27.5%. Look at the growth in profits now. It's gone up from 50,000 to 80,525. Okay, that's a 47% increase just through those incremental gains. Now, these are the numbers that every business owner should know within their business. They should be analysing those numbers on a regular basis. Now, look, I wanted to share, I shared with you at the beginning the impact of discounting your prices. Now, most business owners that I speak to haven't increased their prices for some time. Okay, now our expenses, our costs are generally going up all of the time. Our utility costs, costs of materials, generally going up. But a lot of businesses I speak to aren't increasing their prices. And part of that is fear. Okay, so let me share this with you here. Say, similar scenario, but it's about increasing your prices. So, if your gross profit margin is 40%, and you increase your prices by 10%, okay, you could sustain a 20% reduction in your sales volume. Okay, you could lose 20% of your customers before you were worse off. Okay. Now, look, if you've actually got a lower gross profit margin, it actually increases 22%, 25% of customers that you can actually lose. Okay, now that does two things. Okay, now in my experience, the businesses that I work with, they don't lose anywhere near that amount of customers. They might lose 1 or 2%. Okay, but let's say you lost 20%. You lost 20% of your customers. You're still making the same amount of money. You've created a vacuum to actually get more customers paying the higher price. Okay, so let's look at it in a bit more detail. Same chart as we looked through before. Okay, in column 1. Company sells 100 units at £2 each, net sales of £200. Each product costs £1.20 to produce, so they make 80p profit on each product. Okay, 40% gross profit. So 100 units, they make a gross profit of £80. The area in grey. So then, in column 2, if they increase their price by 10% to £2.20 and they sell the same volume, they would have a net sales of 100 units multiplied by £2.20, £220. The product cost of 100 units remains at £120. So they make a profit of £100 rather than the £80. Their gross profit margin has now increased to 45.45%. Then in column 3, with this higher gross profit of 45.45%, for the company to generate their original profit of £80, they would have to sell, okay, £80 divided by the 0.45, £176 of sales at £2.20. So that's 80 units, a reduction from the 100. Okay, so this is the capacity that you can create in your business by increasing your prices. Many business owners don't do that. Right, so let's move on to the second of my the 3 key parts of financial information, which is your balance sheet. Okay, as a business becomes more profitable, okay, via sort of retained earnings, which are shown in the profit and loss, okay, that gets added to over time. Every year that the business makes a profit, the amount of equity in the balance sheet should also increase. Okay, so like company valuers or investors typically look for healthy net profit and retained earnings. Okay, both profit and loss items, but also a strong balance sheet. Okay, the equity that's in the balance sheet. So these are the 3 things that you generally find, or not generally, that you do find on a balance sheet. Assets, the things that your business owns. Your liabilities, which are the things that your business owes. And then equity, which is the outcome. So let's have a quick look at each of those in a bit more detail. So your assets. Okay, they're generally 2 types of assets. Current assets and fixed assets. So your current assets are the things that are easily converted to cash. Okay, so obviously the money that you've got in your bank account, debtors, people that owe you money, stock that you can sell, easily converted into cash. And then you've got your fixed assets. They've got a longer lifespan, okay? And they're not easily converted into cash. So that could be things like, property or machinery or vehicles. So then we've got liabilities, okay? So these are the things that you owe. Again, there's two main types, current liabilities and long-term liabilities. The current liabilities are debts due to be paid within 1 year. Okay, typically they're supplier invoices. Yeah, but you probably also know them as creditors. And then long-term liabilities, debts to be paid over several years, okay, such as your bank loans. Now, one of the key things to know in your business is your debtor and creditor days. Okay. Now, what are debtor and creditor days? Okay. So this is all about how good you are at getting paid and at paying other people. Okay. So accountants and valuers look at this in terms of the debtors and creditors days. So the term debtor days refers to the number of days that a company takes to collect cash from its credit sales, okay? And it's indicative of the company's liquidity position. It's collections department's efficiency. How efficient are you at collecting it? It's also known as days sales outstanding, DSO, or receivable days. Okay, and here's an example up on the screen in terms of how it's calculated. Okay, so it's your sales divided by whatever period you want to calculate it over. So this is, in this instance, it's calculated over a year, 365 days. So it's £20,000 divided by, you've got 200,000 divided by 365 to give you 36.5 days. Okay, so this business is taking 36.5 days to collect money that it's owed. Now, creditor days is very similar, okay, but it's the amount of time it takes you to pay. Okay, so it shows the average number of days your business takes to pay suppliers. It's calculated by dividing trade payables by the average daily purchases for a set period of time. Okay. So again, what we've got here is 29.2 days when we've gone through that calculation. Now, what that means is that it's your business or this business is generally paying people within 29.2 days. So just looking at this in isolation, and it's something that that a business should be delving down into in more detail, is that it's taking 36.5 days to collect the money that's owed to them. But it's actually paying people in 29.2 days. So it's paying people quicker than it's collecting the money in. Okay. Now, what this can create is something called the cash gap. Okay. Now, the cash gap is the difference between when you pay for your stock or your materials and when you get paid for it. Okay. And I've seen many a business fall over because they haven't managed their cash gap. Now, I'm not going to go into it in more detail in this session, but I am going to run a future webinar about the cash gap, okay, and things to take into account in managing the cash gap and how you can shorten that cash gap. Okay, so look out for that webinar coming up. Okay, now the other thing that I said I wanted to focus on today was the break-even point. Okay. Now, break-even is not just the same as the overheads of the business, okay? Because if you just take the overheads of the business, you haven't factored in the incremental variable costs for each additional sale, okay? Which is why when we're calculating the break-even point, we actually divide the fixed costs by the gross profit margin, okay? So what's the point of working out your break-even point? It tells us how much work we need to do before we start to make money. Now, let me show you this in a diagram form. Okay? So, the red line here, this is fixed costs. They're costs that your business has to pay whether you're making sales or not. Okay? And then what we've got here is the total costs here on the yellow line. Okay? Now that yellow line is a combination of your fixed costs and this purple line here, which is your variable costs. Because your variable costs gradually go up as you start to sell the items that you've got. Okay, so this yellow line here is actually the total costs in your business. So the green line here is your net profit. Okay, and when you start off, or before you're selling anything at all, you're making a loss of 500,000 because you've got 500,000 of fixed costs. And as you gradually start to sell items, that loss gradually turns into a profit. Okay. Now, where the revenues and your total expenses cross these two lines here, that's your break-even point. And the gap that's then built up here as they pass each other, that's your profit. Okay, so one of the key things to know in your business is what your break-even point is. What are your fixed costs? What are your break-even point? And even taking it a step further than that, actually getting to a point where you work out what your profit break-even point is. Okay? Now, what we do is I coach my clients through how to calculate the numbers that they need to know within their business. Okay, their break-even point. And how they can change things to lower that break-even point. What is it, the things that they can actually do? Okay. So look, ask yourself this question. Do I know my historic numbers as well as my future numbers? And this question as well. Test and measure. If we want to manage something, we have to measure it. Okay? If you're not measuring it, you're just guessing. You're just making assumptions. You're just gambling. Okay? So it's about testing and measuring everything that you do. Okay, look, I wanted to move on, but I wanted to clear up a couple of things that I often get asked. I often get asked about what's the difference between markup and margin. Yeah, so let's just have a look at that for a second. So markup is the profit expressed as a percentage of purchase price, okay, or cost. And this is how it's calculated. Profit divided by purchase price multiplied by 100. Now, look, it's easier if I show an example of that. So if you buy something for £100 and the markup on the cost of it is 50%, that means you're selling it for £150 and your profit is £50. Okay, so just think about those numbers for a second. Just jot them down. You buy it for £100, markup on the cost is 50%, you sell it for £150, profit's £50. So what I want to do is just show the difference between margin. Okay, so the margin is the profit expressed as a percentage of sale price. So this is how it's calculated. Profit divided by your sales price multiplied by 100%. So let's look at a similar example that we looked at before. Buy for £100, but this time your margin is 50%, not your markup, your margin is 50%. So therefore, you sell for £200. So therefore, your profit is £100. So the thing to think about here is make sure you're clear on whether you're focusing on margin or markup, because they're two very different things. Okay. What I'd like you to do, just take a couple of minutes to write down 3 learning points you've taken from this workshop. Okay? So I'm going to remain silent for just a minute. Just jot down 3 points that you've learned from this workshop. Okay. Hopefully, that wasn't quite a minute, I know, but hopefully you've written down 3 points. Okay. When we finish this workshop, what I'd like you to do is write down 5 points. Okay. Write down 2 more points. I'd also like you to think about what do you need to put in place to improve the quality of your financial information. Based on what we've talked about today, how much of it do you know? How much of it, going back to that question that I mentioned earlier, rather than saying, I know, isn't that interesting? So start asking yourself those good questions. How much of that information do you know about your business? How much detail have you gone into in your business about each of your products? Do you know your break even? Have you got key performance indicators in place? Are they the right key performance indicators? Let me give you some suggested actions that you might want to think about. Make sure that your profit and loss are up to date. Okay. Don't just wait for your accountant to produce it for you at the end of the financial year. That's far too late. At least have a profit and loss that you're working out on a regular basis. Okay, it's so easy these days, particularly with the accounting software that you can get hold of. Okay, work out your gross profit margin. Work out your break-even point. Select your financial KPIs. Okay, and if you haven't done it, reading Instant Cash Flow. Instant Cash Flow is written by Brad Sugars. Brad Sugars was the founder of Action Coach. He founded Action Coach about 27 years ago. And he's written a whole series of books, but this is a great one if you want to think about more about the finances in your business. Not just think about it, but take action on it as well. Okay, so what I'd like to do is to take any questions. Anybody got any questions that they would like to ask? Type them in the question box, or you can type them in the chat box. But any questions that you've got to ask. Okay, so yeah, okay. Rob's asked here what's profit break even. Great question, Rob. And I didn't explain it. Look, it's fairly straightforward. Profit break even is really it's the same as your break even point. But what you're saying is, I want to make a profit of X every day, every week, every month. Okay, so you add that on to your break even point. Okay, so you know that when you get to your break-even point, you're not making any profit, you're not making any loss. But you know that once you've got to your profit break-even point, you're achieving the profit that you want to make. And every sale on top of that is great. You're making more profit than you thought you were. Okay, so it's very straightforward. It's just the profit that you want to make in your business on a daily, weekly, monthly basis. You just add it on. Okay, anybody else got any questions? By the way, Paul, I love the comment you put in the chat box there that you've said in terms of that cash is king. Absolutely, I love that question or that comment. What is it they say? Turnover is vanity, profit is sanity, but cash is king or queen. Okay, so Ian's asked a question here. Would markup tend to apply to individual product lines compared to gross margin, which often applies to whole business? Absolutely, Ian. You're absolutely spot on there. You tend to mark up your product lines. Gross profit margin tends to relate to the whole business. You can do it. You can use it. You can both. You use them both either way. But yeah. Absolutely right, Ian, in what you've sort of said there. Chris, which do you think is the easiest of the 5 ways to start with? Look, great question, Chris. Now, there's an interesting way of looking at this. In that, one of the easiest ways, or I think the easiest thing to look at, is to look at your gross margin. Okay, because there's areas with your gross margin that you can improve. There might be costs that you can cut. Okay. Now, the thing about focusing on your gross margin as well is that actually it doesn't cost you anything. Okay, it doesn't cost you anything when you're having a look at your gross margin, just to see if there's anything that you can do more efficiently, more effectively. Okay. Okay. Now look, the other point that that I wanted to talk about on the five ways here that you've mentioned, Chris, is that we then look at the other areas sort of first. So we look at things like your conversion rate, your average pound sale, your repeat business. Okay, how many often people come back? Again, most of this doesn't cost anything, and also you can have a bit of fun with it as well. Okay, so they're the things to think about. Then finally, it's about looking at the leads that you generate and get into the business. Okay, because that generating leads can cost money because you invest in marketing, different marketing strategies. Some of them might cost money, some may not, but they might cost money. But also, what you want to make sure that you're doing is when you're putting leads in the top of the funnel, that you'll then, as they go through into conversion, you've got a great conversion rate. There's no point in putting leads in at the top and still having a rubbish conversion rate because you're losing too many. Okay, so the actual generating leads is the last one that we focus on. So hopefully that's answered your question now. Okay, and Tim, thank you for clarifying that you're not Ian. I was getting slightly worried there. Ian's the UK franchise holder of Action Coach. I thought he was keeping an eye on me and what I was doing. So thanks, Tim. Right, okay. So look, what we're looking at next here is my next webinar. Look out for my next webinar, how to generate more business than your competitors with a USP. Okay, so keep an eye on my webpage, hastings.actioncoach.co.uk, events. That'll be posted on there, but I'll also post it on LinkedIn and Facebook, so keep a look out. Now look, I'm also offering complimentary coaching sessions. Okay, so you can book one of those at hastings.actioncoach.co.uk, book a meeting. Look, just go onto my website, click on contact, and that will come up. So you can book a complimentary coaching session. Now, look, just before we finish, your feedback is valuable. Okay, so please send me emails. Tell me what you've thought of this. If you've enjoyed it, post it on LinkedIn, post it on Facebook, because I want to communicate this information to as many businesses that I can. My key is to get movement with businesses, get them moving. Okay, too many businesses are standing still, and by doing things with this, we get movement. Okay, so post it on there. If you've got any ideas, things that you'd like to cover on these webinars, send me an email, let me know. I'll make sure we cover them going forward. Now, the final thing I want to leave you with here on this is, what are you going to do in the next 2 weeks to make more money? Okay, now I'm going to leave you on that point. Thanks very much for joining, everyone. I've enjoyed running this webinar. So good to see you all. Thanks very much. Take care.